So R star is the real risk-free rate of interest, and it is the interest that would exist on a riskless security if no inflation were expected. So it may be thought of as the rate of interest on short-term government securities in an inflation-free world. So the real risk-free rate is not static. It will change over time depending upon the economic condition, and especially it actually depends upon the rate of return that corporations and other borrowers expect to earn on their productive assets, and it will also depend a lot on the time preference of people for current consumption. The borrowers, their expected returns on the real assets, basically this point. So the borrower's expected returns on the real asset will set an upper limit on how much the corporations can afford to pay for the funds, while the saver's time preference for consumption will establish how much consumption savers are willing to defer and save their amount at the different interest rates. It is quite difficult to measure the real risk-free rate precisely, but experts think that it ranges between 1% to 5%. And the best estimate for R star is actually the rate of return on your index treasury bonds. Then moving ahead to the risk-free rate. So like already discussed, that this is also called your nominal or quoted rate, and the risk-free rate is actually your R star, which is your real rate plus the inflation premium. Now the risk-free rate, to be strictly correct, is a rate that is totally risk-free, which means that it has no default risk, no maturity risk, no liquidity risk, no risk of loss if inflation increases, and no risk of any other type. So if you think about it, there is no such security in reality. Hence, there is no observable truly risk-free rate. One security that is free of most risk is considered to be your treasury inflation protected security. In short form, it's called TIPS. Because the value actually increases with inflation, so it's free of default, maturity, liquidity risk, and risk due to changes in the general level of interest rate. However, there's real rate risk still is in this, so you cannot be completely riskless. In general, the T-bill rate is used to approximate the short-term risk-free rate, and your T-bond rate is used for the long-term risk-free rate. Now, inflation, it actually has a major impact on interest rate because it will erode the real value of what you receive from the investment. For example, if you have made an investment of 100 rupees and you will get 110 rupees 1 year later, and the inflation rate is also 10%, then that would mean that you are no better because everything has also gone up by 10%. So the interest rate should be greater than the inflation premium. So it is important to note over here that the inflation rate that is built into interest rate is the inflation expected in the future. So it is not based on your historical inflation rate. It is actually the average expected inflation over the life of the security. So if, for example, you are going to purchase a 1-year bond, so the inflation premium in the 1-year bond is going to incorporate the expected inflation in that 1 year. And if you purchase a 10-year bond, then that is going to incorporate the inflation rate for the next 10 years in the bond. Now over here you can see that there is a graph, and basically the inflation and the long-term interest rate, this is for the US market. You can see that they actually follow each other, they mimic each other. However, the difference between the inflation and the actual interest rate is your real rate. The interest rate also incorporates the default risk premium. Default risk premium is the risk that a borrower will default, which means that the borrower will not make the scheduled interest or interest payments. Now, if a issuer has a lot of default risk premium, which means that there are high chances that the company might default on the payments. So if the default risk is high, then the market rate is also going to be higher because you have to compensate the saver because they're taking more risk with their money by giving loan to you since you have a high default risk. Now you have agencies that actually help in this regard. You have Moody's, you have Fitch. These are rating organizations that provide rating to different types of instruments. Over there, you can go and see that what is the rating provided to Pakistani bonds as well. So they will look at the whole outlook, what is going to happen in the future, what is the current standing, and based on that, they will give a rating that can be AAA to even C. They actually differentiate between two types of bonds. One are your investment grade, which get a good rating and therefore will offer a lower return. Because if the default risk premium is low, the market rate is also going to be low. It's a safe security. And then there are junk bonds. Junk bonds will have a lot of default risk. Because of that, they will offer a higher interest rate, but you will be taking a lot of risk over here. So based on what rating you get, so it starts from AAA and it's a continent. So there will be rating of AA, then B, and then so onwards. Estimate the default risk premium by looking at the difference between the quoted interest rate on a T-bond and a corporate bond. So the difference between their interest rate will give you the default risk premium. However, both bonds, they should be of similar maturity, liquidity, and other features in order for you to do so. In this video, we're going to discuss liquidity premium. So what is liquidity? A liquid asset is an asset that can be converted to cash quickly. Now, there are two types of assets, real assets and financial assets. Your financial assets are more liquid than your real assets. However, even within your financial assets, different assets will have different levels of liquidity. So your short-term market, your money market is going to be more liquid than your capital market. And like we have already discussed that for a treasurer, liquidity is very important because their purpose is not to make the highest amount of profit, but their purpose is to make sure that they make a decent amount of profit and at the same time cash is available whenever required by the business. So liquidity is going to be very important for them. A liquidity premium is added to the equilibrium interest rate on a security if that security cannot be converted to cash on short notice and at close to its fair market value. So there is a cost associated if a particular type of investment is not that liquid. If it cannot be converted into cash that easily, then the market interest rate is going to be high for that type of a security. Now, moving ahead to the next type of risk. we have interest rate risk and the maturity risk premium. Now, the interest rate risk is that whenever the interest rates go up, your bond price is going to go down. Your interest rate and your bonds have an inverse relationship. Now, over here, there is a thing called interest rate differential sensitivity, which means that the longer the maturity of the bond, the higher is going to be the interest rate risk. For example, there is a 10-year bond and then there is a 2-year bond. Both are currently trading at its par value of 1,000 and the interest rate is 10%. Now assume that the market interest rate increases to 12%. This means that the 10-year bond will have a higher decline. So maybe it goes to 700, whereas the 2-year bond will only decline to, let's say, 950. So the longer the maturity of the bond, the higher is going to be the interest rate risk in that case. The maturity risk premium is the effect of maturity risk premium is to raise interest rate on long-term bonds relative to those on short-term bonds. In order to incorporate this risk, your longer-term bonds will have a maturity risk premium added to it, which caters into account that the decline will be greater in a longer-term bond if the interest rate of the market increases. Now, like you have interest rate risk, similarly, you have another risk, which is your reinvestment risk, and it is the opposite. Reinvestment risk is actually higher in short-term bonds. And it is lower in long-term bonds. So the reinvestment risk is the risk that a decline in interest rates will lead to lower income when bonds mature and funds are reinvested. Okay, so let's take the same example once again. So we have a 10-year bond and we have a 2-year bond. Now let's say that the interest rate, instead of increasing, it declines. Okay, remember that interest rate risk is related to an increase in the interest rate, whereas this is related to a decline in the interest rate. So if the interest rate declines from 10% to 8%, now as an investor, if you have the 10-year bond, you are going to be happy because you're going to get the 10% rate for the next 10 years. But the 2-year bond, the investor who has this bond, his investment is going to end in 2 years' time, and he will have to now invest at the lower rate of 8%. So basically, it is related to your reinvestment. So if you're reinvesting and you get a lower rate, is your reinvestment risk. And obviously, it is going to be lower for short-term securities and even securities that are